Peter Rose, Longwood Currency Trading. Critical trade entry setup guidelines. I want to discuss those. We're going to discuss them in two different parts. Trading plan guidelines and then what I call setup guidelines themselves, which are more trading activity oriented as opposed to the analysis stuff that you go through in a trading plan. It's end of March 2022. I don't know whether you can hear the wind howling outside. I was just outside, took the bow dog out to just to take him out, and took a picture of the missing wood pile. I think if you've been following my videos through the winter, you've watched the wood pile out there dwindle, and so here's a picture of a non-existent wood pile, and then we came back in to do this video. Let me put a slide up now which will show you the discussion that we're going to be undergoing in this video, hopefully not too long. As you can see, we're broken down into trading plan guidelines and setup guidelines, and there's 4 or 5 bullets to each one of those. So we'll come back here and we'll discuss those. Critical trade entry setup guidelines. Why do we have two distinct areas? The trading plan guidelines and the setup. Trading plan guidelines are those things that you do ahead of time, not when you're sitting down to trade, but they do have a lot to do with your ability to successfully evaluate a trade entry setup. That forms kind of the basis of the setup guidelines that you actually do. The setup guidelines are foundation on the trading plan guidelines. So let's go over those with that thought in mind. So the first point of the trading plan guidelines is, are you a short-term or long-term trading plan bias? Is my feeling that unless you have an enormous amount of experience, you're either going to be a long-term position trader, you're going to be a swing trader, or you're going to be a day trader, which will include scalping perhaps, although scalping is really a separate thing that you don't want to do until you have 300 or 400 trades under your belt and you kind of understand the slow motion application of rules that you're going to have to do boom, 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 boom instinctively when you scalp. So don't go into your learning process to be a scalper. Go into it at least from the standpoint of a short-term trading. Even if you want to be a long-term trader, you need to know how to do short-term trading because you'll learn a lot, and those techniques, those strategies, all that you learn as a short-term trader are directly applicable to the stuff that you're going to be doing as a long-term trader. The things that you do as a long-term trader are not transferable down into short-term trading. And so best to learn the basis and then go to your long-term trading and apply those principles, but with a different time element involved in it as to when you execute. So your trading plan, which sets the environment for your trading, has to make a statement as to whether you're a short or long-term trading plan trader bias. You have to. You can't mix those. Even as an experienced trader, I don't think you want to mix them. I don't think one day you want to be short-term trading and banging away, and the next day you go, I think I'll sit with this trade for 3 weeks and see how it goes. I mean, I don't think those mindsets are transferable. The rules are transferable, but I'm not real sure about the mindset. I'm not really successful as a long-term trader. I make money, but as I've said in other videos, I don't feel that I'm paid sufficiently for the risk that I took or for the time that I was involved in the trade. If you take the net profit of the trade divided by the number of days that you were in that trade, how much larger is that going to be as opposed to what you could make on a daily or weekly basis just trading on a daily basis. So those are the things that you need to establish early on as to what is going to be the type of trader that you're ultimately going to be. And again, these critical trade entry setup guidelines are already geared for the person who's got all this stuff figured out. This is just a checklist. In other words, a pilot doesn't go in to learn how to fly the plane by having a checklist. They already know how to fly the plane. But the checklist keeps them safe. And that's what these guidelines do. So are you a short-term or long-term bias? You have to know that because that affects the price action look-back window, which is the second bullet point in the trading plan guidelines. A price action look-back window is when you're looking at a chart, how far back on that chart are you going to look? If you're trading on a daily time frame, then your look-back window better be longer than 7 days, right? You're going to have to look back at least 30 days, and probably 4 months if you're going to be a daily trader. If you're on a 5-minute time frame as a trader, your look-back window might be 4 hours or 8 hours or something like that. So you kind of have to determine how far you're going to look back. Remember, price action is caused by orders being executed by institutional traders, not by the 15% retail traders that are out there. Although it's a huge dollar volume, and it does affect the movement of price, it's the institutional traders that are the dog, and they're just wagging us. We're the tail on all that. You got to keep that in mind, or you're going to get this stuff wrong. So your price action look back window is how far back are you going to look at stuff. If you look too far back, you're looking at economic conditions and clients that are trading, asking for execution of their orders for totally different purposes. You know, if you look back at the current situation that we're in right now, we have a Ukraine invasion going on right now, and that wasn't the case 3 months ago. So what are you going to do? You're going to look back 3 months as to what price action was doing, as to how you're going to trade over the next month? I don't think so. You got to be very careful about that look back window that you're using, as you need to be if you're up on the daily chart and those moving averages they're looking at. What are you going to look at? A 55 period? You're going to look at a 200 period moving average, and you're going to factor in normal trading activity with the situation in the Ukraine. If you happen to be trading euro-based currencies, although this thing is really affecting the whole world, you have to be smart about this stuff. The trading plan, like anything else, is not cast in concrete. You know, if you go into vastly different economic conditions, you've got to go back and change your trading plan, or not so much change it, but if you understand what you're doing, you have a couple of different versions of your trading plan. You have trading plan when you're in highly volatile conditions, and you have trading plan when you're in, quote, normal conditions, price action conditions, right? So let's be reasonable about how we're looking at this stuff. The third bullet point under trading plan guidelines is your chart analysis and trading time frames. So this goes right back with your price action look back window. I mean, if you're doing chart analysis and you're doing that analysis based on the time frame that you're trading on. So what time frames, what chart time frames are you looking at? Are you looking at 5-minute and 15-minute time frames? Or are you looking at daily and 4 hour? Where are you at? What are you looking at? Are you looking at 1 minute, 5 second, 5 minute, 1 minute? What are you doing? Because you tend, or you should be, using multiple time frame analysis. You use the higher time frame or frames to determine price action directional bias, and where your trade entry could take place and where your structural elements exist. And then when you actually trade, you drop down, let's say you're doing that on a 15-minute chart. And then or let's say you're doing that analysis on the 4-hour and maybe you're getting your trend bias from the 4-hour, and then you go down to the 15-minute for some structural analysis for where you might enter a trade, where you might be, where your profit target might be, and then you might slide down into the 5-minute time frame, which would be actually the time frame that you use to actually put the trade on and to make your then position management decisions after you get out of the trade entry phase of your life cycle of a currency position and move into position management. You're on that 5-minute chart doing all that stuff. You might only use that 4-hour chart or 1-hour chart or whatever you're using for your time frame bias just in that initial analysis, and then that's gone. So when we talk about multiple time frame analysis, we're generally talking about 3 time frames, but you're only using the highest of the time frame for your position bias, and then the other 2 time frames are your setup and trade management type time frame, and then your lower time frame is going to be the actual time frame you use for your trading, right? So that stuff, your chart analysis and trading time frames that you're looking at, those charts are going to then give you an idea of your the 4th bullet, which is your trading activity window. When are you going to trade, and how long are you going to trade? You can't just say, well, whenever I get up, I'll sit down at the computer and I'll trade, or when I get back from lunch, or you can't do that. You have to become familiar with price action during certain time frames. If you're trading at trade opening, let's say, and then all of a sudden you go out to an hour before, quote, close for that currency pair, activity close for that currency pair, price action is completely different. I mean, if you look at U.S. and Euro pairs, what happens at 4 o'clock U.S. time? Well, U.S. is going, those traders are the orders were executed between, in U.S. time, Eastern time, between 8 or 7 and 10 o'clock. At 4 o'clock, those guys are looking to close up the day, work with their clients and all that other kind of stuff. There's minimal trading that's going on. There's trading, but it's not as strong with those European countries because at 4 o'clock in the afternoon here, it's 9 o'clock in Europe. There's nobody sitting at the desk in Europe. It's the night desk. Okay? It's the retail traders that are out there banging around. Do you want to compete with the retail traders? I don't know. So you have to pick a trading activity window. That's the time that you're going to sit in front of the computer and trade. I'm going to trade from U.S. Eastern Time, 7:30 to 11 o'clock, or whatever that is. Or I'm going to trade U.S. currency versus New Zealand or yen or something like that. Maybe I'll be trading that at 3 or 4 o'clock in the afternoon. So you're trading off the Pacific U.S. exchanges with the Japanese and New Zealand and Australian currencies. So where is your trading activity window? The price action is going to be different in that 3 o'clock time frame, 3 to 5 or 2 to 5 time frame, than it is 7:30 to 11. So you need to determine in your trading plan where your trading activity window is. And finally, in the trading plan, you have to define your risk management style and rules, because those shouldn't change based on conditions. Only you might have different risk management and rules for, quote, regular price action as opposed to high volatility conditions. Non-farm payrolls, war in Ukraine, tsunami events, economic events, that kind of thing. And those are coming up. Or if you don't, there's surprises and you immediately have to shift to a different risk management and rules and style and rules. So let me put this sheet back up again, this slide. Critical trade entry setup guidelines, trading plan guidelines. So let's go back through them. The trading plan should include guidelines for short or long-term trading plan bias, price action look-back window, chart analysis and trading time frames, your trading activity window, and your risk management style and rules. Okay, so let's come back here. So the next critical trade entry setup guideline area is your actual setup guidelines. So those setup guidelines are personal health, time, and emotional conditions, news or economic events within the look-back window that you've defined in your trading plan, current price action as a function of past price action within the look-back window, and the price action structure proximity analysis within the look-back window. A sip of coffee. What does your personal health, time, and emotional conditions have to do with it? Well, first of all, your personal health. If you feel shitty, you're plugged up, you got a cold, or whatever that is, or maybe your roids are flaring, whatever the thing is going to affect your trading. It's going to affect your thought process. Personal time. If your trading time frame is 7:30 Eastern U.S. time to 11 o'clock, and at 10 o'clock you're expecting a call from a contractor who's going to set up a time to come out later in the day to tell you how much it's going to cost to fix your garage that a tree fell through. Your attention is not, even though you're able to focus somewhat on what's going on, it's still a distraction, right? Your time, the time. If you don't have the uninterrupted time, you might think about not trading then, or say, look, I'm really going to take short-term positions here, because at 10 o'clock I don't want to even be in the market, and so you trade 7:30 to 9:30 or 9 or something like that, and then you just go flat and you're there. You don't have that problem if you're a day trader, because you're making all your decisions. I mean, not a day trader, but a long-term position trader on the daily chart, because you're not going to make any decisions until 5 o'clock anyway, U.S. Eastern closing time, right? Quote, closing time. But your time, that time is a factor in how well you're going to be able to trade. If you don't have, at 5 o'clock, you don't have time to look at that chart, and you're trying to squeeze that in because you're supposed to be at a dinner with somebody at 5:30, you're not going to do a good job of that. And your emotional conditions, both your health and time affect your emotional conditions. Well, you could be arguing with somebody, you could feel depressed for the day, maybe a good friend of yours told you to go screw yourself, and that makes you feel bad. Whatever the emotional condition is, you just can't trade, because what will happen is you'll end up revenge trading, because you're going to lose, right? You're going to make a loss, and then you're going to revenge trade to get back. So you just don't want to do that. So in your setup guidelines, you have to take into consideration your personal health, time, and emotional conditions. And if there's any problem there at all, then there's no setup guidelines, because you're not going to trade. Next, is there any current news or economic events that happened within that look-back window? So if you're, let's say you had you're trading from today you're going to trade from 10 a.m. to 1 p.m. Eastern U.S. time, and you just had U.S. non-farm payroll at 8 o'clock in the morning, for example. What conditions are happening in your look-back window? You're looking back 4 hours or 2 days or whatever it is. You have to take into consideration the anomaly of price action that occurred in that look-back window, because isn't that going to screw up your moving averages? Hasn't price action violated certain structural points that you have? Most importantly, you have to look at your ATRs and your moving averages, because those have been radically affected by those large price swings. Your moving averages are if your moving averages include the time frame that event happened, that moving average is not valid. You just can't use it. I'm telling you. Nobody teaches this stuff. I have no idea. Look, I watch a lot of these videos, and I've got all these books here on trading. Nobody's talking about this stuff. I talk about it when I'm in consulting and mentoring or doing coursework with the students. I don't have very many students because it's too expensive. People don't want to pay. They want the magic secret sauce. Okay. All my videos contain all the magic secret sauce. You just have to watch 190 of them to get it all, and then figure out what the key points are. It's much easier just to pay me and learn the stuff that's important as we go along, but nobody seems to want to do that. So we'll see how that goes. Those of you that do that, you benefit from it, and that's great. I'm glad I was able to help you out. But that look-back window becomes really critical when you're looking at if there's any news or economic events within that, because the third the setup guideline is looking at current price action as a function of past price action. Current price action has nothing to do with past price action, and past price action and current price action are affected by the ripples of that economic event. Prices recovering. You have price that has these big sinusoidal movements, and then they go like that. It's called a damped harmonic oscillator if you're mathematically inclined, so that the moving average the moving average of closing prices would look like this. It comes off of here, and you have this long tail at the end, and now you're back into what you call regular price action. Well, when does that happen? How far past non-farm payroll will you get back to regular price action, where the ripples from the non-farm payroll event have dissipated? Well, if you're looking at moving averages and the non-farm payroll happened within 21 periods of your chart time frame that you're looking at, the 21 period moving average is invalid. What's valid? The 8 period time frame. If you're on the hourly chart, you could look at an 8 time frame period, as long as the non-farm payroll was 20 hours before, because that gives that action time to dissipate, so that you're looking at a moving average that reflects really currently what normal price action is all about. Geez, you guys, really have to consider this stuff about moving averages. All these people are teaching this stuff about moving averages, but they don't understand the mathematics behind a moving average and what happens to that moving average. You're making decisions based on stuff that isn't true. God. So current price action as a function of past price action is really an analysis that you have to be really good at. And it's the foundation of some of the seminar or whatever that I would go over with somebody. And in setup guidelines, the final guideline is price action structure proximity analysis. We usually define price action structure as support and resistance lines. Now, if you don't know how to draw them, and it's not just drawing them across the top of the candles. Do you draw them across the top of the candles, or you draw them across the top of the wicks? Do you have to have 3 touches or 5 touches? How far back is the touch point that you're going to use for that support or resistance line? Is that support or resistance line, because they're not lines, they're zones? Is it a 5 pip wide zone or a 25 pip wide zone? Well, is it based on a 15-minute candle, or is it based on a daily candle? Man, oh man, oh man. People talk about structure and they don't understand how to use the structure in relationship to the time frame that you're trading. And that time frame is part of your trading plan guideline, right? And so that ties into how you're going to evaluate your setup. Because your setup is based on price action, yeah? So price action structure proximity analysis, let's just say you're going to go long. You have a price that meets all of your setup conditions. Yep, there's a profit target that's worth striving for, and let's say that profit target is at the bottom of the closest resistance zone. So you're 10 pips below that on a 15-minute based structure chart with a zone that's 10 pips wide. So your profit target is 5 pips below that, and that leaves you supposedly 20 or 30 pips, so that price has that 20 or 30 pips to move up toward that 5 pip profit target below the zone, and you can move. That's fine if that's the case. But if your entry point that you're thinking about going into is 10 pips from the resistance zone, that's a structure proximity event that you can't take that trade. Okay, so that's what that means. All right, let me throw the slide back up again and go back over all of those things so that we can summarize this crap. So, critical trade entry setup guidelines, trading plan guidelines. You need to determine short or long-term trading plan bias, price action look-back window, chart analysis and trading time frames, trading activity window, and your risk management style and rules. Those are all within the trading plan guidelines. Your setup guidelines have to be based on your personal health, time, and emotional conditions. They have to be based on news or economic events within the look-back window. They have to be based on current price action as a function of past price action within the look-back window, and even before that, if the event is not valid. And finally, you're looking at price action structure proximity analysis. It's that becomes sort of the cornerstone of the point where you actually go in to say, oh, okay, I'm really going to seriously look at this trade. Okay, so let's get back from our setup here, all right? Because I want to talk a little bit about that price action structure proximity analysis. Because it isn't just the proximity analysis to structure that we're talking about, but it is that price action. The determination of whether you're going to have a trade entry event or not is based on the momentum of current price action. And I define momentum as current candle size as a function of the ATR. If you have increasing price momentum, then that's a trigger. For me, it's a trigger event. There's a rule there, and there's a way that I look at that. And I can arm wave my way through it for you, but you'd really have to take a course in that in order to understand it. And it's not something that I go over in a video, because I'd be just like all these other guys out there who are trying to tell you a system. It's not a system, it's principles, but it's very difficult to get principles across in a video when it becomes complex at the actual solution set level of that principle. because then people are trying to duplicate the solution set instead of looking at the principle. So that's why I just stop at the principle-based level. Regardless of that, your trigger event for a trade entry is the price action, not the structural points, not the moving averages, not the freaking Bollinger Bands, fucking bat patterns, and all the other shit that people are trying to tell you that it is a Fibonacci spiral of death pattern. It's bullshit. All of that is bullshit. If you think I don't know what I'm talking about, I got a bachelor's degree in physics. I spent 33 years as a senior software engineer designing complex enterprise business applications. As a software engineer, I've had a 40-year career, a successful career, by the way, in real estate investment. I retired a millionaire, over a millionaire, because of the investment. I didn't just fall off a truck. And I've been looking at the currency markets since 2007 and spent, I don't know, 8 or 10 years doing it as an academic exercise, programming simulation analysis and all that other stuff, using mathematical principles and other principles against trading. And I've looked at the psychology of trading, and I've studied this stuff. And so if you think I'm shitting you, you'd be advised to rethink that and to compare what I'm saying with what a lot of the folks are saying. Oh, you just set these lines, and when the short moving average crosses here and it's confirmed by the RSI, then you're ready to go in. Go ahead, try it. If that stuff was true, then why is it that 90% of the traders lose 90% of their money in 90 days? And that's an actual statistic from a large retail Forex brokerage outfit, studied 42 million client transactions. And Tom Halgrove has, I don't know how to pronounce his name, was also he was a broker. He's on the other side of the fence. He watched literally hundreds and hundreds of thousands of transactions and thousands of traders and their results. And he'll tell you, as well as anybody else, there are reasons why 90% of the traders lose 90% of the money in 90 days. It's because of the education that you're watching on the videos and the books that you're reading. And it isn't that that's bad, it's that they don't know how to teach, or you don't know how to take all the information that's in a book and willow it all down to the key principles and then build your trading plan around those key principles, because they're trying to present to you how to trade, because they think that's what you need to know. That's not what you need to know. You need to understand the principles of trading, not how to trade. You're supposed to figure out how to trade. If you try to trade the way that I trade, you'll go broke. If you use the principles that I use, you'll be fine. But nobody teaches principles, because everybody out there wants the secret sauce magic. People emailing me all the time. How do I trade entry? How do I do this? Should I use an RSI or should I use I'm using Fibonacci and it's working real good for me, except when it doesn't. What do I do? I get this stuff all the time, and all of the people that are out there that are on YouTube that are getting emails and questions, they answer those questions. Oh yeah, you gotta set your RSI or your Bollinger friggin' Bands. You don't want it to be 14. You want it to be 22 and or whatever, and then it'll work. Or you're not setting up your bat frickin' pattern right, or your Fibonacci, the 38.6 level, that isn't as strong as the 50. Anybody who answers a question like that doesn't know what they're talking about. They may know how to trade, but they don't know how to convey to you what they're doing. And so they rely on those types of indicators. This stuff that I've just showed you is a small microcosm of the study of trading. Does it look complicated? Yeah, probably it does. We covered a lot of points. Are you a better trader because you listen to any of that? Probably not. But it'll make you a better analyst, and that will be what makes you a better trader. But I'd venture to say that 90% of the people who started watching this video aren't watching it right now. You know, at this particular time, at the end of March of 2022, with 190 videos posted, it's 2 a week, it's a year and a half or 2 years of videos that I've been on posting these videos. I have 300 subscribers. Thank you very much, by the way, for the subscription. Some of you, a lot of you, all you do is subscribe, and I don't think you ever watch because you're subscribed to 50 different channels. You're all over the place. So I'm not going to benefit you. But out of those 300, maybe there's 10 or 20 that are benefiting from it, because you're patient and you're going to listen to this stuff and you're going to try to figure it out. You're going to send me an email. What can I do? If I can help you briefly, I'd be glad to do that. But if we're going to work at all, I would send you what I call a student questionnaire form. And that asks you what kind of trader you are. It basically asks you the trading plan guidelines and your experience within them. There's about 18 questions that you are asked to fill out, how much ever you want to fill it out, and send it back to me. And I'll look at it, I'll pick out the highlights, I'll write my comments down, and then we'll set up a time to video chat. And I'll try to show you where I think you could use some improvement in what you're doing based on what you've told me in that questionnaire form. And we'll chat about that. Give you a half an hour maybe, if you need it. No charge and no pressure to spend any money with me. If I can help you in a half an hour, I mean, I don't have very many people that send me emails to start with, and there are even fewer than that are going to fill out the questionnaire form and follow through. So I've got time to deal with you if you're really serious. If you're not serious, I'll try to help you the best I can in a short response. If that's all the time you want to give me, I'll try to help you. But all I can do, someone who contacts me and says, "Well, I'm using this Fibonacci thing and I can't figure out the difference in the two levels, why one works and why one wasn't." You know what my advice is? Don't use the Fibonacci. But that's all I can tell you, because you're looking for an answer to a problem that really shouldn't exist for you. There are a few people who are going to be medical doctors. There are a few people who are going to be architects. There are a few people that are going to be software engineers or chiefs of police or the head machinist in a shop. You have to approach your work with a significant passion that you're going to take the time to learn those skills. And this stuff on critical trade entry setup guidelines is critical stuff. Each one of those bullet points that I went over is a seminar. And if I'm going to do a seminar for someone, it's usually in a group, be 2 or 3 hours. Each one of those points. But I'm going to get right to the chase and discuss that stuff. That's how important this stuff is. Those are the nodes of importance that you would need to just trade entry setup. What happens after the trade is placed? What are you doing then? Where is the defining line between where you go from trade entry phase to position management? If you don't know where that demarcation point is, you're going to be trying to mix position management into your trade entry and you're going to fail. And where does the exit methodology phase of the life cycle of a position take place? When do you start considering that? And what principles are involved, and what rules are involved? What, how, and when do you do exit methodology? Those all have equally weighted complexities in their analysis. How do you learn that stuff? You can't learn it by reading a book or listening to me just go through a list of guidelines. You're going to have to study them in terms of the principles behind the guidelines. Not what do I do if this and this and this and this happen? Because this, and this, there's an infinite combination of things. If there are two things that you have that you're looking at, you have 4 different permutations of those 2 things. If you have just 5 conditions that you're looking at, RSI, moving average, economic event, if you just have 5 things you're looking at for correlation, you've got 325 different permutations you could arrange those 5 things in. So you're reading these books and you're watching this stuff and you're looking at these critical trade entry setup guidelines, and there are that's 5, there were 9 of them. Jesus, look at the permutations in 9 things. In 5, they're 375. In 9, there's could be, I don't know what it is, be 14,000 or something like that. There's a lot. I'll try to do the best that I can in these videos in order to point out key nodes, key principles that you need to consider. And then, if you're going to do this on your own, take that thing that I just talked about and go investigate that. Read specifically for that information. That's what you're going to have to do. If you take a course from someone or some mentoring or consulting, and you say, you know, I'm having problems with this, then listen to the principles. Most people will just say, oh, well, if you have a problem with that, then you change the time frame on your ATR. Please, come on, stop. I'm not out of coffee, but the coffee's cold. And so, Peter Rose, Longwood Currency Trading. Have a great day. Have a great trading day.